Happy New Year, everyone. Welcome to 2025. So I once again have a special guest, my business partner and lifetime friend here, Ken Zorvich. And Ken, welcome back to the, I would say the podcast, but this is not really a podcast. This is just us talking about mortgages, talking about the market.
Yeah, what an exciting topic.
Exciting.
Too bad we don't do something cooler.
Deadliest catch or something like that. But
yeah, come on.
As we kick off the year here, just thought we'd go over three topics. These are probably things that are on people's mind, especially if they're in the market to buy a home. So we just want to talk about rates. We'll talk about the job market, and then we'll end on our outlook on housing for 2025. That's going to be the special one. So if you want to hear that, you got to stay till the end. All right, so Ken, let's talk about rates. Give us a quick update. Where are interest rates at right now, and kind of what's been influencing rate? What's been driving them?
Yeah, so everyone was optimistic we'd finish the year with rates comfortably in the sixes, and instead they climbed to comfortably in the sevens. And the reason for that is because the market data that influences interest rates, okay, we're talking inflation, we're talking job reports, these things just haven't cooperated. And what I mean by cooperate is they haven't come in below expectations, meaning job growth is still solid according to the data that's come out, and inflation is not hitting the 2% target that the Fed wants it to hit. Now, the Fed continued to lower interest rates, and even though they lowered interest rates in December again, it's the first time since, I think, the 80s that mortgage rates went up after the Fed had lowered their interest rate. So it's not common that this happens. But the reason that's happening is because the market is still worried, mainly because the Fed decided to revise how many rate cuts they expect for 2025, which was only 2 rate cuts. Okay, they originally were thinking maybe 4. Now they're thinking only 2. So immediately money started pulling back and bonds started to sell off, and that caused mortgage rates to rise. So everyone is just repositioning their money right now and waiting. And I think what we saw last year is money started flowing ahead of when the Fed was making their decisions because they wanted to get ahead of whatever the Fed was going to decide to do. And now I think that the market is going to be reactionary. They're just going to wait till the Fed makes a decision or wait to see some data that would support their decision to do it and not speculate. So that's why you're seeing interest rates frustrate everyone and be back up into the sevens.
Yeah, it's always interesting when the Fed cuts rates. This is very confusing for people, right? Because they're thinking the Fed cut rates, mortgage rates should go down. And we always say, like, look, first of all, the Fed cuts short-term rates. It's the overnight rate that has some influence on mortgage rates, but it's not so much the actual action they take that day. It's what they say afterwards, right? It's the comments that they make. Are they going to allude to future rate hikes? And that's the problem. I don't think people pay attention to that part of it. Investors do. A lot of that stuff is already baked into pricing. They'll come out and kind of know what the Fed's going to do. But then more importantly, you have to pay attention to what they're going to say afterwards. And it was Powell's comments where, to like you were saying, we were anticipating, 4 to 5 rate cuts in 2025. And what does he do? He comes out and says that there's probably going to be maybe a total of 2 rate cuts. So this is why we saw mortgage rates go the opposite direction and finish the year up as opposed to, coming down. And, it's very interesting, like Ken mentioned, rates are sitting right now, just above 7%. And, there was a time in September where we got down to right around 6. Remember that? It was probably a 2 to 3 week period where we got down to 6s, and mortgage applications did spike. The problem was it was so short-lived. It was just this little pocket. There was a couple people that got in and refinanced. But what that did show us, what that demonstrated, though, is that if rates can get down there, there is demand, right? It will create activity. I think that's really the sweet spot. If we can get rates back to close to 6%, it'd have to be a full percent drop from where we're at now. But that would definitely kind of kickstart the real estate market. Do you agree with that?
Yeah. It's been the correlation the last, I'd say, 2.5 years almost, or we're going to almost be hitting 3 years since 2022 when rates started rising. it's been the correlation. If rates go down and that hits the mainstream and the marketplace, people want to come into real estate. Like I think there's an element still of give me a reason to feel like I'm getting a good deal if I'm going to go buy real estate, right? And interest rates one of them, right? Interest rates one of them. So
Yeah, no, it definitely is. And the only thing that like the good and bad news right now with interest rates is this is probably the highest we're starting. I mean, even in 23, when rates topped 8%, they started the year lower than where they're at now. But so that's the bad news. But the good news is we're probably at the height. I think we kind of both feel this is where, rates are going to max out. We could see a little volatility, but the long-term plan is down. So I think the good news is that maybe the worst is behind us or the worst is here and it can only improve. So hopefully we'll start to see rates come down, and that will spur more activity, and it'll obviously get more buyers off the sidelines.
yeah, we just need to remind ourselves rates were almost 8% at one point. So
Yeah, not
they
that
look
long
great
ago.
right now compared to that.
Not that long ago. We remember. All right, cool. Let's move on to jobs. So jobs is a big indicator of how the market moves. Everyone's paying attention to that. It also influences interest rates as well. So just give us your quick take on the job market and kind of where you see the job market heading into this year.
Yeah, I actually think jobs will be the reason interest rates fall over inflation. You hear this 2% that the Fed wants to get inflation to. The reality is that if you really pick apart inflation right now, real-time inflation, what's happening in the current situation we're in, when you track it, we're actually in a very good spot inflation-wise. The inflation readings, though, pick up old information that just hasn't caught up yet. And it's going to take a little bit more time for that to catch up. But what could spark the Fed to act quickly and get the market to understand that now would be the time to buy into the bond market is jobs. I think we're going to see jobs slow down and we're going to see unemployment rise this year. There's just too many indicators out there that are just kind of like the tea leaves that I think some people don't want to believe or they want to wait and see it happen. But so there's two that come to mind right away. And so every month we get the jobs report, right? And we see the market move according to it. If jobs come in below expectations, we see rates get better. If jobs come in above, we see rates get worse. Okay. In the month of January, I think it's the end of January, beginning of February, they do a revision. Okay. And this revision got brought up during the campaign trail a bit. And there was a revision from Q1 of 23 to Q1 of 24 of over 800,000 jobs that were never created. Okay.
Yep.
The expectation right now is that Q2 of 23 to Q2 of 24, there's going to be a revision up to 1.2 million. Okay, which tells you 1.2 million less jobs were really created last year. Yet we've been trading and the Fed's been making policy as if all this was happening. And if that's the case, then you could see that the job market is not quite as strong as it is. So that's one thing that I look at that I think that's going to eventually catch up to the marketplace. And I also look at right now, there's other countries throughout the world that contribute to the global economy between Europe, between China, and their economies are struggling. Their economies are struggling, and I find it hard to believe that we could somehow stay above that we won't feel some impact of that struggle that they're experiencing to eventually hit home and see companies start cutting. Maybe they're not adding new jobs, and eventually it just becomes too tight, and we're going to have unemployment rise.
Yeah, absolutely. I know we like to kind of think we're on an island here, but the global impact will impact us at some point, right? Eventually it's going to spill over. I just want to backtrack for a sec because I think it's important for people to realize, what the Fed's job is. Like the Fed has a dual mandate. Their job is to keep inflation under control and to create jobs or make sure that we have a strong growing economy when it comes to jobs. And to Ken's point, I mean, inflation is kind of like maxed out in this 3% range. I know they're markers to get to 2%. So I don't really think when it comes to interest rates, inflation like coming down it's going to like come down quicker than it really is. I think it's going to be stagnant here for a little bit. So really, I think the only thing we can bank on as far as lower rates is the job market. And Ken mentioned about how, they come out with these jobs reports and how many jobs we created, and then months later they'll come back and revise them. But, in my personal opinion, I feel like that hasn't really got the market to move too much with the job creation. I think the bigger thing we need to look at this year is the amount of unemployment filings, the people losing their jobs, not so much gaining jobs, but losing jobs. So really pay attention to those unemployment claims and the unemployment report. If we start to see that go up, regardless of job creation, I think that's when it could be the alarm bells finally go off and we could see the Fed start to take some action and lower interest rates. So yes, we're going to pay attention to inflation, but really that job report is going to be the big factor in getting interest rates down. And you hate to root for anyone to lose their jobs, right? But it's just maybe the inevitability of what's going to eventually happen, just given the economic conditions right now. But if it does happen, then we should see lower interest rate. That's kind of a way to compensate for loss of jobs.
Yeah, agreed. And I think that from the job standpoint, it's going to impact inflation also. Like part of the reason why inflation is up is because jobs are like our unemployment's so low, so people are working and they're spending money. So that's why if you think that jobs are going to start to pull back this year and retract a bit, then inflation has to be following, right? Like they're going to go hand in hand on that.
Absolutely. Perfect. All right, let's move on. We'll wrap it up, but just give us your outlook. How do you think housing in general is going to look in 2025? Are you bearish? Are you bullish?
So there's two things I look at with housing on why I think we're going to have a better year in 25 than we did in 24. First is the fact that in higher inflation times, which we've experienced over the last few years, one of the best assets to own during an inflationary period is real estate. And everyone that owns a property out there right now has felt it. And so I would say to the people that don't own a property, I think you're going to be okay if you get in this game. You might not like where the prices are. You might not like where interest rates are, but I don't think you're going to lose on this investment. I think this investment will continue to go up. And that's a good thing. So that's kind of the silver lining in all of this mess over the last couple of years with real estate is even people that took high rates and bought, a couple years ago, they've seen their property value rise. And that's a good feeling in the in the monthly statement you get that you have to make that payment on. So I think that's going to happen. And the other thing I think is going to happen is I think the last couple of years we're giving people the opportunity to wait on something, right? Wait on prices to slow down, wait on interest rates to come down. And that just hasn't happened to the extent that people want. So I think that it's kind of given people the idea of, okay, what am I waiting on then? I need to just go and do this. I need to go and make this happen if I'm going to own real estate. So in my mind, I think that's where we're headed, is that there's more just kind of people looking at the market saying, I still want to own real estate, so I'm going to buy. And then we're still going to see real estate going up. So we'll probably see transactions finish higher than we did in 24.
Yeah, I agree. I don't think I'm necessarily bullish, but I'm very optimistic compared to last year. I do think we'll see growth. And to your point, I mean, the people that have waited, that has not been a good decision for them with real estate. You're waiting for this perfect time. Like you said, prices come down, rates come down. But guess what? You've lost out. That home 2 years ago is now more expensive. We are still seeing appreciation levels. The appreciation levels are cooling, but they're still going up nonetheless. So real estate, if you look back 60, 70 years, we have the data. Other than a few pockets, one being the financial, crisis back in 2007 and 8, real estate has done really, really well. It's been a great investment. This is why that 40X club terminology that's thrown out there for people that own compared to people that rent have a 40 times greater net worth. So yeah, I kind of echo you with 2025. I think we're going to see a little bit more transactions, probably an increase of about 10% that we saw last year. I don't think it's going to be anything crazy, but the X factor there could be the Fed. It could be things like if rates do come down. And going back to jobs for a second, I think there's really two sectors we need to pay attention to because this will kind of drive the economy, is manufacturing and new construction. If you start to see those two areas slow, and builders, we've already seen permits slow. Housing starts; those are slowing. Even though new construction has done well, we're starting to see a slowdown there. So if the next thing that comes is job loss in that sector and in manufacturing, which has already slowed as well, that's when you could see job losses pick up, unemployment tick up, and then rates come down. So,
Yeah.
but Ken, so people aren't freaking out when that happens, what industry does well during a recession?
Real estate
There we
always
go.
does well during a recession because even if you look back when take the 2008 out of it, anytime we've had recession, what happens? Interest rates soften up, and even though unemployment rises, it's not necessarily to the point where people aren't out there buying properties, right? Yes, if we go from 4.2 to 6% unemployment, it'll feel uncomfortable. People won't be happy, but it's not the end of the world, and the industry doesn't stop. And with rates softening up, that's going to be more motivation for people to want to go out there and finally do something either they've been putting off or waiting on.
Absolutely. So listen, control what you can control. In real estate, you can't control the rates or the prices. If now's the time for you to buy, just jump in. It's always still a great investment. Ken, thanks for joining me today. And
Yeah.
2025, here we go, baby.
Let's go.
Let's go. All right.